So in this lesson, we're going to be looking at candlestick anatomy, support and resistance, and market trends. So what is candlestick anatomy? Candlestick anatomy talks about the body of the candle, the upper and lower wick, the open price, the close price, the high and the low. Now the distance between the low and the high of a candle is called the candle range. Okay, so you have a red candle and then you have a green candle. The red candle most times depicts bearish, and then the green candle depicts bullish. So a candlestick shows you what price did within a period of time. Each candle tells a story, whether buyers or sellers were in control. So like I said, the candle is made up of the body and the wicks. So when price opened low and closed high, it represents bullish candle. Then when price opened high and closed low, it represents a bearish candle. So when you have a bullish candle with long body and small wick, it indicates a strong buying pressure. Also, when you have a candle with small body and small wick, it indicates indecision. And also when you have a candle with small body and long wick, and the candle is bullish, it indicates rejection and strong bullish price behavior. This is also true when the price is bearish. Now let's look at some types of candlestick pattern. Every candle is a battle between buyers and sellers. Your job is to understand who is winning. So you have the big white candle there, right? And then you have the hangman. The hangman is a black one with long wick. And then we have the spinning top, in which you have a small body at the center, and then you have two small wicks. And then you have the shaving head, right? So you have the shaving bottom, which is a bearish form of shaving head. And then we have the marubuzu candle, in which there is no wick at all. And then you have the hammer, the bullish and bearish armor. Okay, then you have the doji, which indicates indecision, in which you have very tiny body and then wicks, upper wick and lower wick. And then we also have the dragonfly doji, which is very tiny body. Then we also have the gravestone doji. All of these are candlestick patterns, and they are very important when they occur at key levels. You also have other type of candlestick patterns such as the bullish arami, the bearish arami, the tweezer top and tweezer bottom. You also have the morning star and the evening star. So all these candlestick patterns, like I said, when they are formed in key levels, they give you confirmation to enter a trade. So like I said, candles tell a story. Long wicks show rejection. Strong bodies show strength. You are not just looking at candles, you are reading market behavior. Now, in the next aspect of this lesson, we're going to be looking at support and resistance level. So price respect these levels. It doesn't just move randomly, it reacts at key zones. So a support level is a level where price tend to stop falling and bounces up. It acts like a floor. So about resistance level. Resistance is a level where price stops rising and falls. It acts like a ceiling. So support and resistance levels are levels where you tend to look for buying or selling opportunities. For example, when the price reaches a support level, you want to look for candlestick confirmation, to enter for a trade. When it reaches a resistance level, you want to look for selling opportunities when you see a candle confirmation. So support and resistance levels can also switch roles. For example, when a resistance level is broken, it becomes support. So price comes to retest it, and pushes up. When also a support level is broken, it becomes resistance, and price comes to retest it and pushes down. So trend lines can also act as support and resistance. For example, support trend lines tend to push price up, while resistance trend lines tends to push price down. So for example, when I want to draw a trend line, I'm going to connect one swing point to another swing point, and then I wait for a third touch, a third swing point before I enter for the trade. either to buy or to sell. So like I said, support can become resistance and resistance can become support. This is a powerful concept in trading. Market trends. An uptrend is when price is making higher highs and higher lows. This means buyers are in control. A downtrend is when price is making lower highs and lower lows. This means sellers are in control. We also have a third type of market, which is called the ranging market or the sideways market. And this is characterized by price making equal highs and equal lows. So when price is not going up or down clearly, it's in a range, and this is called a sideways market. So traditionally, when you want to trade the ranging market, you look for buying opportunities when the price gets to the support, right? And then you look for selling opportunities when the price gets to the resistance level. So before you take any trade, always ask yourself, is the price going up, down, or sideways? So in summary, we said that candlestick anatomy talks about the opening price, the close price, the body of the candle, the wick, and then the range. Right? And then we said when the price opens low and close high is bullish. When it opens high and close low, it is bearish. And then we also talked about support and resistance level, where we said support acts like a floor, which tend to push price up, while resistance level acts like a ceiling, which tend to push price down. And also, we also talked about market trends, where we say we have three types of market. We have the uptrend, we have the downtrend, and then we have the sideways market or the ranging market.